Welcome back to the Wealth Effect. If you walked into a fast food place restaurant this week and noticed a slick kiosk where a teenager or someone starting off their career used to stand, you're not just looking at tech progress, you're looking at the fallout of the $20 an hour accounting problem. For nearly a century, the minimum wage was supposed to be the floor for the American dream. We've seen the longest freeze of the minimum wage in US history and a robotic arms race that is physically redesigning our stores. Today on the show, we're going to break down the total cost of labor. We're going into the 25-cent revolution of 1938. Before the federal government stepped in to stabilize the labor market, the American economy operated under a philosophy of pure extraction. In the early 20th century, the value of human per hour was determined by the absolute desperation of the worker, leading to the race to the bottom that saw child exploitation in textile mills and families living in company towns on wages that barely covered the cost of their living and food. This wasn't just a labor crisis, it was a systematic failure of the social contract. The turning point came in 1938 with the Fair Labor Standards Act, the FLSA, signed by FDR as a cornerstone of the New Deal. The act was designed to be a floor below which minimum wages cannot fall short of. It wasn't a fiscal policy, it was a moral boundary set at 25 cents an hour, intended to protect the purchasing power of the bottom of the economy, to ensure that the fruits of the industrialization was shared, however minimally, with those providing the sweat that made it happen. If we look at the minimum wage through the lens of real value rather than nominal dollars, the narrative shifts from progressive to an erosion one. The golden age of the American floor occurred in 1968 at the nominal rate of $1.60 an hour. The minimum wage reached its historic peak of purchasing power equivalent to $14 to $15 in today's inflation-adjusted numbers. During this era, the floor acted as a reliable escalator, basically. As the American worker became more productive through technology and infrastructure, their base pay rose along with it. However, the 1970s triggered the Great Decoupling. Productivity continued upwards, but the minimum wage became stagnant, pinned down through political gridlock and shift towards supply-side economic priorities. This created a divide between what the worker produced for the GDP and what they were legally entitled to take home, transforming the minimum wage from a living wage to a survival wage. We are currently navigating the historical anomaly that has fundamentally altered the soul of the American labor market. The federal minimum wage has remained frozen at $17.25 since July 2009, the longest period of stagnation since the law was introduced nearly 90 years ago. This frozen floor has effectively outsourced economic policy to the states, creating of what we call a patchwork frontier. Because the federal government has abstained its role from adjusting the floor of minimum wage, a worker value is no longer determined by their output, but by their zip code they live in. There's a whole divergence where the fry cook in Seattle might earn double the hourly rate of a worker doing the same exact task in Mississippi. This geographic arbitrage has turned the US into a weird labor competition where states like California and New York experiment with $15 or more minimum wages, while others remain tethered to the 2009 valuation that has been basically eroded away due to the crazy inflation we experienced in 2020. The modern debate over minimum wage isn't about the price of the burger. It's about the fundamental clash over the purpose of entry-level labor. On one side is the latter theory, which views minimum wage as a temporary starting ground meant for teenagers and those gaining experiences for their first job. In this model, the floor must remain low to prevent entry-level displacement. The idea that if the floor is too high, the ladder is pulled up and the most vulnerable workers are replaced by automation or higher skilled applications. Opposing this is the foundation theory, which argues that economical denomination by service sector jobs, the minimum wage is no longer the starting place, but a permanent floor for the millions of adults that work those jobs. For these workers, the floor isn't a transition to a higher position. It's the infrastructure of their whole lives. As we move on to the next section, we have to ask, is the floor meant to be a safety net that catches you, or are you supposed to move up from there? In the world of finance, we often talk about the money illusion, the cognitive bias where people view their wealth in nominal terms rather than adjusted for inflation. In 2026, this illusion became basically pretty intense in the labor market in the US. While we're seeing hundreds of headlines of breaking wages across 19 states, the reality of the story is that the purchasing power wasn't there, it was actually worse. Today, understanding workers that earn $18 an hour in Flagstaff or $17 in New York City are still struggling just as they were before. We have to look at the past numbers to check the real wage of this. The distinction is pretty simple. Nominal wages is the face value of your paychecks, while real wages is the actual buying power which you can go to the grocery store or gas to purchase. In 2026, as of March, nominal wages in the US grew roughly 3.5% on paper, which looks pretty good. However, with inflation hovering at 3.3%, the real growth for the average wage was less than 0.5%. After a year of full work, the record rise translates to about $6 more per week in actual purchasing power. This definition of running and standing still is the nominal numbers that are climbing, but the finish line never stops moving. The reason the struggle feels so real is in high minimum wage areas, and those regions suffer from disproportionate inflation in non essential costs. In the state of California or New York, where the floor is $17 to $20 an hour for specific sectors, we see an emergence of basically the high wage trap. Because housing, energy, and services are sticky and labor intensive, the very act of raising the minimum wage can lead to a localized feedback loop of price increasing. For workers in high cost living area cities, a $3 nominal raise is often immediately predated by a $200 monthly rent hike or double digits increase in the actual utility costs. In this environment, the minimum wage isn't a springboard. It's an increase that is eroding away quicker than they can raise it. For the bottom 10% of earners, the cumulative real wages gained since 2020 are now actually falling below the pre-pandemic trends, meaning the raise they received during this time is essentially just gone. They thought it would repair and keep growing, but it's completely gone, fallen out of their pocket. To combat this, many jurisdictions have moved to a cost of living adjustment or indexing their minimum wage across to the CPI, which is the Consumer Price Index. On paper, this is a really smart alternative to the 17-year freeze, but the indexes have a lagging problem. Indexes usually happen once a year based on past data. If inflation spikes in the first quarter, workers spend the rest of the year with diminished purchasing power before it even gets fixed. In places like California, where fast food consulate recently pushed a specific adjustment, we've seen a 3.5% index increase fails to offset the 4.2 rise in the actual cost of living faced by low-income households who spend much more higher percentage of their income on volatile essentials such as rent and food. This creates a shadow stagnation. Even in the most progressive labor markets, the floor is barely maintained at its 1960s strength level. The illusion of this higher wage is being shattered by the reality that they're still struggling at these higher paychecks, all due to the inflation environment and the nominal illusion of it. For decades, the minimum wage was culturally synonymous with the starter job. It was basically the domain for teenagers behind the counter or college students just doing low skill, low effort works. And it's low stakes environment where the owner basically paid for what they got and didn't expect a big output. As we've moved through the years, the mechanism of this high wage floor has fundamentally changed how these entry level jobs work. When the minimum wage in major jurisdictions hits that $20 mark, the starter job basically stops existing and is replaced what we call a competitive entry. This is where the high cost of labor forces employers to engage in human capital discrimination. In a $7.25 world, an employer can afford to spend 3 months teaching a 16-year-old the soft skill and the hard skills about customer service. But when it's $17, the training becomes a luxury for them basically. They can no longer sustain random people leaving and coming back. We're seeing a massive demographic change. The average age of the new hire in the US has climbed significantly, with many entry-level service job roles are now being filled by adults in their 30s and 40s who begin their years as reliably and day one productivity. When the floor is high, this training budget basically goes away. Employers are increasingly looking for a plug-and-play worker that has led basically the experience creep, where entry-level jobs are now posted frequently to have 2 to 3 years of relevant job experience. Recent data suggests that 40% of entry-level listings are ghost posting, roles that aren't actually intended to be filled but only exist to harvest resumes and to see what the workforce is actually out there looking for. The youth barrier isn't just about being replaced by older workers, it's also reinforced by automation. At $17 an hour, the return on investment for automation has become undeniably feasible. For a franchise owner that can no longer choose between a teenager and an adult, it's between $20 an hour for a human or a self-service kiosk, which doesn't call days off or require any training. The first task that once served for everyone's entry-level job of taking orders, basic inventory, and repetitive things are now becoming extinct due to AI and robotics. By automating the grunt work, that effectively removing the shallow pool, young workers are now expected to jump straight into the deep end of a skilled labor without actually having learned the basics of these professional environments. This is more than just a temporary unemployment spike for Gen Z and the emerging Gen Alpha. This is basically a systematic erosion of the human capital, where the price of a starting pack is already experience that you don't have because you can't get. And you create a skill debt where the economy now struggles for young workers to actually have any feasible skills. Without that first job at 16 or 18, a worker reaches their mid-20s without the fundamental professionalism that would have been taught at these workplaces. This also creates a growing divide where the employed elite, those who got jobs before the price rise, are protected, while the unskilled youth are increasingly pushing towards gig economy or hidden unemployment, where they lack the traditional benefits and a stable W-2 income. The minimum wage was intended to be a safety net, but due to these elevations and indexes level, it just becomes a bigger barrier for entry. In the clean lines of an economic textbook, rising minimum wage is a simple transfer of wealth from the corporate balance sheet to a worker's pocket. But the messy reality of this is where profit margins are being compromised by high interest rates or sticky inflation. Businesses don't want to absorb these costs. They are re-engineering the very structure of their whole workforce. This has led to two different side effects: disemployment effect and the rise of hour arbitrage. The most obvious reaction to the price increasing is the reaction of reduction in demand, where the cost of labor crosses a certain threshold, which is at, let's say, the $20 mark. This is where the return on investment on a human often turns negative. Instead of massive layoffs, many firms are opting for shadow cuts, where workers leave the position simply because it isn't backfilled. The worker is just either automated or distributed among the remaining staff. There is also a trend where employers trade up. If a company is legally mandated to pay $19 an hour, there is no longer a hire an entry-level candidate that requires training. Instead, they're waiting for overqualified applicants, some with a degree of years of experience who can hit the ground running, effective deleting the rest of the workers that are there. Perhaps more damaging than jobs disappearing are jobs that are hollowed out to save money. Companies are increasingly shifting their workforce from part-time to full-time status. This isn't just about hourly rate. It's a sophisticated mathematical play to avoid benefits cliffs. Under the current federal and state mandates, full-time employers, typically 30 to 40 hours, trigger massive additional costs. This includes health insurance, 401k matching, and higher unemployment insurance premiums. By capping an employee at $28, a company can effectively subsidize a higher minimum wage by stripping down the non-cash compensation that makes these jobs a little more appealing for people. There is also just-in-time scheduling. Enabled by the new scheduling software, managers can now predict customer footprint with precision. Instead of a now stable 9 to 5, workers are given micro shift, 4 hours here, 3 hours there, to optimize every minute to ensure the company never pays a single second of idle time. The result of this phenomenon is documented in high wage experiments from Seattle to New York, the net loss paradox. While workers' hourly rate might be going up 15% or more, their total hours are being cut by 20% or more, and their monthly pay actually starts to shrink. Politicians often point the rising wage as a success, but rarely talk about the average weekly earnings that they actually see. This shift focuses on the portfolio career of necessity, patching together 3 different part-time jobs to reach 40 hours worth of income without a stable benefit or a single employer. By raising the floor, we're not incentivizing a functional labor model. We're basically cutting away at the 40-hour work week from a single company. In the classic economic tug of war, labor and capital are often two of the primary forces. For decades, labor is cheaper option than a last mile of service. Flipping the burger, scanning the barcode, and packing things. As of more recently, the rising Florida minimum wage has accelerated robotics. Instead of paying a human $20 an hour, why not just buy a $100,000 robotic arm that doesn't get distracted? We've reached a breaking point where upfront capital is actually much cheaper in 3 years of total cost ownership than an entry-level person. The experiment in California where fast food workers raised the minimum wage to $20 has become basically a case study. The data from the first half of the year suggests that 25% of the wage hikes go straight to the boardroom. Recent data suggests that every $1 in increase in federal minimum wage corresponds to an 11% increase in the likelihood of the firm adopting robotics. To avoid massive upfront costs, businesses are actually now hiring robots on a subscription model. For a flat monthly fee, which is often less than 2 full-time employees, a restaurant can install a fully automated frying machine or a fleet of floor scrubbing robots. This turns capital expense into operating expense, making automation more accessible to mid-sized franchises that couldn't previously afford this huge robotic army. The most radical shift isn't that robots are standing where a person should be. It's that the physical redesign of the economy now incorporates automated environments. In dense urban centers, traditional storefronts are often described as dark stores, fully automated micro-fulfillment hubs that aren't open to the public. There are no cashiers, no greeters, no floor staff. Orders are placed via agents and picked up overhead by robots in seconds. We've moved past the self-checkout into basically a zero-click retail, where AI agents handle transactions and robots handling the logistics. The need for basically a human intervention is basically engineered out of everything. In this model, the minimum wage is irrelevant for everyone because there is no employee. And the irony of the labor market is that by trying to make the floor more livable, we basically incentivize it to just disappear. In California alone, the fast food industry reportedly shed nearly 20,000 jobs since the $20 mandate went into effect. Not because demand for burgers went down, but because the productivity per robot was higher than the cost per human. A robot doesn't trigger payroll tax, doesn't require workers' compensation, and critically doesn't suffer from benefits cliff, as we discussed earlier. The jobs that are left are more technical. There's more jobs moving from manual labor to fleet management. The workers who used to flip burgers are being replaced by technicians who manage these fleets and repair the burger flipping machines across different locations. In a traditional debate, we treat government as the referee of the economy and setting the floor prices for things for a couple of years. But as we've seen now, the government is lagging, slow, inefficient, and often touches things so slow in the economy that it's no longer effective by the time they come into place, which creates radical schools of thinking and the emergence of ideas that the minimum wage should remain low to preserve industrial competitive, while workers themselves act as the primary workforce for this change. This shift is rooted in decentralized negotiation. If the government sets a wage, it is a blunt instrument that applies to all coffee shops in a rural place and in major cities. But a more elegant solution would be actually to go one per one. When workers protest or boycott a specific employer, they're providing a real-time market correction. They are signaling that the current price of labor is below the equilibrium required to sustain this operation. Unlike a bill that can sit in a committee for years, a well-coordinated labor action can force employers to raise wages within weeks. The biggest pushback against these wages are price pass-through. The idea that if labor goes up 10%, the cost of the burrito will go up 10%. However, this assumes that corporate profit margins remain untouched because a true balance requires a customer veto. If a company raises prices to protect its 25% margin rather than absorbing the labor cost, the market's failsafe should be that the consumer should boycott the company entirely. For this to work, consumers must be willing to walk away from the brand that they prioritize as high margin protection over the health of their own ecosystem. This is basically a game of chicken. While the free market activism is theoretically the most effective way to run an economy, it faces massive coordination problems. For boycotts and protests to work requires a level of utility that is rarely ever achievable. If 90% of workers strike, but 10% of them still continue to work, the market is basically muffled. Without a legal floor, there's always the risk of race to the bottom, but the most vulnerable individuals often accept this because they still need this job to survive, effectively still subsidizing the corporate profits that keep them in poverty. The minimum wage debate is often framed as a battle between greedy corporations and exploited workers, but it's a little more delicate than that, as we've seen before, and it's pretty dangerous because the reality of real numbers and nominal numbers are different. Maybe the solution isn't to pass a bill in DC. Maybe the solution is finally something a little more local to each person. But who knows? We'll see what the future brings. Thank you for listening. Until next time.